And welcome back. The S&P 500 on pace for another record close. Let's bring in Trivariate Research founder and CEO Adam Parker, also a CNBC contributor. Adam, good to see you.
Great to see you.
All right, Adam, I'm happy to see you. I don't think a lot of economists are happy to see you. Out with the new note, you're basically saying we only need a fraction of the economists that we have right now. They're always looking backwards, but I got to talk to you about the action that's happening right now. Our Pippa Stevens just did some reporting on Goldman raising their oil forecast for this year. WTI and Brent seeing both of them being higher at the end of this year. Economists keep telling us if oil prices stay higher, inflation is going to be higher, and it's going to be harder for the Fed to cut. Are they wrong when it comes to that, too?
I don't know. I mean, I just think investors might be complacent about oil. Almost everyone I meet with, we just did a big dinner with a bunch of risk officers last week. Most people are not embedding in their estimates that oil stays elevated for a really long time. If you look at the forward curve, so like Brent oil 12 months from now, it hasn't really moved a lot since the original spike after the Iran conflict broke out almost 2 months ago. So I'm worried people could be a little bit complacent. Our main conclusion is to be cautious on some consumer discretionary stocks where maybe there's downward revisions possible. My point was more just on things like, the equity market leads GDP, right? So economists probably should be using stock price action to help their predictions, not the other way around.
All right. Coming up this week, we have the Kevin Warsh confirmation potentially. There could be a vote. A lot of talk about what happens after that. How are you viewing the selection of Kevin Warsh, his if he passes through the Senate, and also what that means for how the market views the Fed and also how the market views the bond market? By the way, our Rick Santelli out earlier today saying he only gave a C+ to the auction for the 2-year.
I mean, there's two sides to it, right? I mean, if you look back to the end of 2022, the correct call was to be short Tesla, Nvidia, Meta all the way through 2022, and then get long January 1st, 23. And your logic was that, hey, they're still hiking, but they're closer to the end of the hiking cycle in the beginning. So at that point, eventual accommodation on the front end was seen as very bullish for price to earnings multiples. But here we are 3 and change years later. I'm not convinced that if they start cutting, the market's going to say yay, and multiples are going to expand a ton, because I only think they're going to cut if they're worried the economy's dropping off and that estimates or there's a growth scare. So, there's the interpretation of the Fed cutting has different meanings at different points in the cycle, and it's definitely less juicy at this point in the cycle than it was 3.5 years ago. But if you look at the other side, which is the balance sheet, if somehow the mood changed and they start expanding the balance sheet, that would definitely be unbridledly bullish, because obviously balance sheet expansion and equity market expansion are pretty correlated.
All right, let's get to something that is very juicy. Big tech earnings, 5 of the Mag 7 reporting this week. We had Cameron Dawson here earlier. She was talking about the rise in capex spending, and a lot of these stocks have traded higher on increasing capex spending. You're saying that dynamic, I believe in your new note, may be changing, and a lot of equity investors, they don't want to continue seeing these mega cap tech companies continue to spend.
Well, I listened to Cameron, and I agree the way she phrased it. As always, she's so lucid. But I mean, I think it's Goldilocks you need for these guys, right? It has to come up a little bit so people still think it's game on the ROI from all the AI spend. If it gets too much and the porridge is too hot, then maybe people would freak out. The history of equity markets is actually to not love capital-intensive businesses. There have been some exceptions, energy, utility, select cable, media, telco, where it's perceived as return that's coming in the future. Obviously, that's the initial phase of AI build-up. People are assuming this will be a positive. Look, if you back up, though, Frank, most long-only investors, institutional investors, benchmarkers against the S&P have been constrained on how much of this grade 8 they can own. I call Broadcom in there, too, instead of just the Mag 7. So if you take these gigacaps, whatever you want to call them, people have been underweight because of 525 mutual fund rules or because of old risk management rules. So the problem is it really hurts them when they outperform. And if you look back to the March 30th lows and the huge move in the equity market in the last month, all of them, except for Tesla and Apple, have massively outperformed the market on the way up. So I think people need to own more of them. Obviously, we wrote in our note we think NVIDIA is a good one to own. I just think it's too risky to be underweight this group.
So let me ask you, the narrowness of this market, should it be concerning? Goldman out with the note that saying about 85% of earnings growth is going to come from tech. We heard Cameron saying she's a little bit concerned. Brian saying he wasn't that concerned. Where do you stand?
Well, there's always that level versus change debate, right? Normally stocks work on change, meaning you'd rather own a company when margins are going from 1 to 2% than from 80 to 79, right? That rate of change matters. I think the challenge right now is the absolute growth is so high. Tech earnings are supposed to be 42% year-over-year growth this year in the S&P 500. Yes, a lot of that's Micron, the memory cycle, NVIDIA. And they're supposed to grow another 25% in 2027. So let's say analysts are crazy, the estimates are way too high, memory rolls over at some point, and the earnings only grow 30 and 20 or 30 and 15. A fair question would be, do you think that tech is going to be down in absolute terms on 30 and 15% growth over the next 18 months? In other words, do you think the multiple is going to contract 40, 45%? I don't think so. And so I think that's part of the reason why tech's acted so off the bottom is people are realizing that the estimate achievability, even if it's a problem and they're too high, stocks can still appreciate with 30% growth and some modest multiple contraction. So I don't think, I guess I'll thread the needle on both of them and say, yeah, the estimates are too high. I'm generally worried about that, but the absolute growth is still strong enough. Equities can be decent.